I'm just thinking about when I have to use that term Roach Motel with somebody. No, that's great.
So full disclosure, I didn't come up with that on my own. That was my boy Brendan Ahern at Crane Shares, the CIO. He loves a good Roach Motel. All right, here we go. 1, 2. Hey, everybody. Welcome to This Week in Pre-IPO Stocks podcast. With me is Nick Fusco, CEO of AView, a pre-IPO secondary market pricing company, and Clint Sorenson, Chief Investment Officer at WellShield, an outsourced CIO and investment research company. Don Nitti, who's our fourth fellow that usually joins us every week, unfortunately couldn't be with us, so we'll see him next week. We've got 3 topics queued up for today. We got Bytedance, Reddit IPO, and a tightening pre-IPO secondary market, or what potentially could be a tightening market. All right, so let's get into this first topic here. So we got Bytedance, right? So Bytedance is the largest pre-IPO stock by valuation. It's got TikTok, which I think most people are familiar with, and then they got several other products in mainland China. These guys did $61.7 billion of revenue in 2022. I had no idea it was that big. 2 billion users. That's like a third of the population, global population uses this, right? And it's Bytedance is up 20.5%. You can see it's a little bit of a round trip here, right? Over the last about 2 or 3 years. The $216 billion valuation is where I have them right now, and that's up from $180 billion in December of 2020, right? But so, boys, any thoughts on the chart here before we jump into some comments or questions that I have for you?
It's definitely in a downtrend, which is yes. A little evident there. But yes. I think that's just the nature of the beast. I mean, I didn't realize how big they were. So this was impressive to me, just looking at the amount of revenue they did. It was just absurd.
Yes.
But maybe they're breaking out. I don't know. Like if you look at it, recent trends, seeing them up 21% is nice, but that's kind of a blip on the map. So we'll have to see
what it looks like.
Yeah, it's interesting. I mean, the chart that we pulled up on the screen for anyone just listening in, it looks a bit like a bell curve, and Clint and I were speaking before. You can almost have a mirror image with Snapchat. So we pulled up Snap and took a look. You actually do see some similarities here, but I think you almost have a stronger business with regards to what you're getting over at at Bytedance with the TikTok growth, right? So you're really getting a lot a lot more users, a much higher revenue that's being kicked off from the individual users on TikTok as well. So yeah, it's almost curious that we have that parallel between those two charts, where I would feel that Bytedance is a bit stronger. But Clint and I were also chatting about the political environment is very different. So the headwinds or the unknowns for Bytedance are kind of difficult to address without bringing up the presidential election coming up, what the relationship with us shooting down all Chinese weather balloons is looking like, and things like that, right? So maybe that's an appropriate thing to hit on where that valuation's going, because it's really not trending in the right direction. It's going down considerably, almost to where the last round was 18 months ago, or I forget when it was.
Yeah. Well, so that kind of begs the question, like, Clint, do you think that this first of all, so with all the political stuff that's going on, and considering it's mainland China, and like these folks don't have a legal entity from what I can tell outside of mainland China. So, if you're investing in this mainland China legal entity, plus there's all this political stuff that goes on. I mean, it's an attractive business. I agree with what you guys said, but can you invest in something like this, or is there just too much hair on it, right?
I mean, I think you're going to see, and I've talked to a lot of institutions in regards to, and wealth managers, et cetera, about investing in China, because we personally see it as an opportunity. Everyone's running away from it. Flows are running away from it. Big money's running away from it. But you've got an economy that's growing. They're pumping liquidity into the system, and their stock markets are on a positive trend and cheaply valued. So when I start to look at those assets, I get super interested. Problem is, I don't know how much capital they're going to attract from us domestically. Right. I'm not really worried about like our domestic boycotts of them from a perspective of user growth, because they already got 2 billion users. Like we could add every American there. You got 330 million users added. It's not even moving the needle. So I think at the end of the day, they've got it really comes to a flow of funds problem and a capital investment problem. And I think that's really where the issue lies with this company. I don't think it's with the revenue. I don't know, what other products do they have? You guys familiar with what other products they have? Like how do they monetize the 2 billion users other than just through TikTok?
They got a lot. They have so first of all, there's like a TikTok version in mainland China. Okay. But that's more, it's funny, that's like educational only. So it's a very different experience than TikTok we have here in the United States. They also have like a Slack type solution. They have like a YouTube type solution. So it's a lot of like, I don't want to call them Me Too type products because naturally it's China, right? So it's not like they have the same type of competitors that they have here in the US. A lot of these US kind of social media companies aren't live there in mainland China, but that's the business, right, Clint? That's the kind of flavor of it.
Yeah, but to bring back to Clint's point, the interest. I'll put my data hat on and bring that to play. A lot of the interest that we're seeing on the secondary market for the top 20 names with the most liquidity, it's almost like a 1-to-1 between bid and offer right now. But you're actually getting a lot different for Bytedance. So it's one of the biggest volume names we see, but it's like 1-to-4 or 1-to-5 in the ratio between bids and offers on the name. So definitely part of that downward pressure.
Okay, hold on. So that's with the selling. More people are looking to sell than to buy.
Absolutely,
that's what you're saying?
Absolutely. Yep.
Interesting.
So I can't say who the sellers would be. All of that is anonymized. We don't get access to that. We don't pursue that. But yeah, definitely a lot more sell pressure on that for the last probably 6 months if I pull it up. Yeah.
That's super interesting.
I mean, think about it if you're a firm, right? You're making an investment in TikTok and you're a large firm and all of a sudden you know that's a major political talking point across both sides of the aisle. And the libertarians like me. So it's all over the map. Everyone's kind of talking about TikTok this, TikTok that. So I think it's a tough spot.
Yeah. Well, I mean, look, I did a little business in China, right, myself over the years, and just getting capital in and out of the country is like not straightforward, right? It's not like you're investing in a company in the UK or Germany or something. That's like super straightforward. So there's some nuance there, right?
There's friction.
Yeah. Well, there's also regulation too. So it's like, I mean, it's not like it's a slam dunk that you can pull the money out. So like you can kind of get it in there and then now you got a whole bunch of money in China, you can't really get it out, right? So interesting. It's a very interesting dynamic. But I'm fascinated by Bytedance. Like when I look across all of the I'll call it like emerging markets and frontier markets for pre-IPO stocks, there's some interesting names, like a few in India, 1 or 2 in Singapore. Like there's some interesting names out there, but Bytedance is by far and away like the biggest. Right.
I mean, look at the story. Think about the users. Like the 2 billion users is just an unbelievable statistic. Like when you start to really think about the size of these companies in pre-IPO equities, we get out of our like U.S. domicile. We start thinking globally. It's impressive, and I'm super optimistic about it long term. Just because the sheer amount of people and user opportunities globally is just amazing in comparison to what we've dealt with in the United States. And we've seen amazing wealth creation, at least temporarily in Snap's case, amazing wealth creation with a lot of these organizations and a lot of these companies in the social media space because they're building a community, building a network, and they capitalize on the network effect. And I think Bytedance has done that beautifully. I just don't know if it's going to translate into a lot of capital flows at this point in time due to the political hurdles.
Yeah, that sounds right. It sounds right. Okay, let's talk some Reddit here real quick. All right, so Reddit there's some rumors that these guys are going to IPO in the second half of 23. So the information is kind of the Silicon Valley focused publication. So they had some buzz, some sources that said that these guys are going. They keep updating their paperwork in with the SEC. They had 290 million in 2020 run revenue, but they're not profitable, right? So it's like an interesting time, I think, for a company that's not profitable to go public. So Nick, like in a few, I noticed there wasn't like a huge market, right, for these guys. It seemed like it's pretty light trading in the secondary, but you did have data in there, some activity in there, a book in there. So it's 32% down. I have them at $6.8 billion as the current valuation, right? Fidelity came in and priced them at 6.6, right? That was the valuation that Fidelity put on it. Then that's down from 10 billion in August of 21 from their last primary financing round. So thoughts on Reddit, right? And first of all, do you guys like Reddit? Like as a user,
I don't use it.
You do.
I mean,
don't
I've
use
used
it, or
it through a search. I've used it, but I don't like log into Reddit. Reddit's not like my chosen user experience. And I don't know. Yeah, I mean, it's just not. It's kind of clunky. There's just a lot. I mean, I'd rather get pointed there and click on it and read through it than like immediately go to Reddit for my first source. Google still kind of dominates search for me, and maybe the whole Bing Chat GPT thing takes it over. Although I hear some creepy conversations are occurring on the Bing integration, but like, you know, maybe it's when search gets a little easier and I go away from that. But look, I Google everything. Google's now a verb. I Google everything, and I think that's the only time I go to Reddit.
Right. Well, that alone, I think, is interesting because I kind of view Reddit. I don't view Reddit as a search engine so much as it is like it's like a Facebook or social media spot. But it's more like, you know, but it's clearly a different experience, right, from those other social media platforms.
Yeah, but I think it's interesting the way Clint brings it up as search, and you're right. I kind of side both ends. That it's maybe not a search engine, but they actually do make their money in a very similar way, right? So they make their money selling advertising and optional premium memberships that wipe some of the ads off the page, or they also offer like your managed ad campaigns, auction-based advertising, like all the ways that a Google or a Bing would actually make their money is kind of in scope. And funnily enough, that we were talking about Bytedance prior, I think two of their more notable investors, which is a lot of fun. You've got Tencent, so another multinational Chinese conglomerate that focuses on entertainment and media. And then you also have Snoop Dogg, which is kind of cool, right?
Snoop Dogg.
So always got to bring that up. You've got two very different interested parties at play. But yeah, to Clint's point, they actually do make money a lot like a search engine would, right?
Yeah. So okay,
it's centralizing internet information. It's centralizing information to their website instead of to a node or someone's independent site, right? They're just organizing that information so you can find it. At the end of the day, that's always search to me.
So guys, what do you think if these folks do in fact go public, okay, and with negative net income?
How are you going to do this at this stage in the game? You're getting 5% on treasuries. There's a lot of alternatives. 5% on a 6-month T-bill, and they're trading at, what'd you say? It was 6.9 billion or
6.8 billion is where I had them.
At
right?
290, so you're talking almost 24 times revenue
for
a
was
negative income company. What's their pathway to profitability other than marketing and ad revenue? And we've seen that model kind of take a nice, slap.
Nosedive. Yeah, right.
Yeah.
I just don't see it.
Yeah, I mean, what do they have to differentiate? They do have an interesting captive audience, but is that a fad or is it a proper trend? They've got the backing of Tencent, so if they want to have that angle of the media company, drawing attention to it, some nuclear fallout with Twitter, so maybe people are kind of going in between, and maybe it becomes the flavor of the month. But in terms of proving their profitability or the path to it, I agree with you guys. Like, it's not been proven out here yet. Ad revenues are falling. Things are changing in that space that I don't quite understand. But it could be
I don't see it.
Profits over promises. Profits over promises in this one. And one of the things my question is pull up that chart of their valuation. Was that at the height of the whole meme stock mania? Because Reddit got a ton of attention during that time, and I was just curious as to when that was. Right around that, right? So if you think about it, that's where really Reddit got super popular. And so if they should have IPO'd, they should have IPO'd then. While it was, taking advantage of the meme stock craze.
A lot of companies, I think, missed the boat there. Actually, that's a perfect segue, Clint, into this third topic that I wanted to get you guys' opinion on. So this fellow Henry Pierre Jacques, who is a general partner at Harlem Capital here in New York. He's actually, I've never met him, okay, but he's like a really smart guy. I follow him and I read about his stuff. But he kind of came out with these kind of, I'll call it trends that he's seeing, right? So Nick, I know you sent something over that says maybe something a little different, but this is what he's seeing based on his conversations with companies as well as with VCs. So like things are just tightening up in general in kind of the seed and Series A space, right? And then also there's just kind of like you need to have more done to get this revenue, or I'm sorry, to raise capital at each of these respective stages, right? And I know, so Nick, you had a little bit of different data that you'd seen from Fortune where it shows that, you know, it's actually getting better, right, in 2022. So that's the exact opposite of what Henry said. He's kind of seeing and feeling out in the market.
Yeah, but why don't we read it out for the benefit? I mean, the chart that we've just pulled up, Source PitchBook posted up in Fortune term sheet, I think this morning, and it just shows this absolute trend of median valuation for seed pre-money going from 5 to 6 to 7 to 8, and then a nice chunky jump from 2021 and 2022 to a median of 10.5. So again, for seed pre-money valuations, and an average of 20 plus. And then I think you can speak to the Harlem Capital. We're kind of seeing the inverse. So who's right? What is what's actually out there?
Well, I mean, I have been hearing from people that it's tightening up. That's also been my experience too, right? And it's when I kind of put that topic out here for us to discuss about. That seems to be kind of the general trend. And also too, what I'm also hearing is that you got to have more done. Like you could go to get a seed capital, and you could, you know, maybe have like a concept or be pre-market product market fit, or like definitely kind of having kind of a product live and customers with it. Now it seems like you need to have a product live, you need to have customers, you need to be showing that they're like paying you consistently. If it's a SaaS product or kind of recurring revenue, it's even better. And then you can get like an attractive or kind of a proper valuation. But even that's down from where it was before, right? So just things just seem to have, that's what I was hearing, which matched up with what Henry says, hence the topic, right? But I mean, I don't know. I mean, Clint, I know that you kind of dabble in the venture capital and in seed investing space, right? Like, what do you see?
Yeah, I mean, I've seen it come in quite a bit. I've actually seen term sheets pulled as far back as 2021, right? So 2021, like at the tail end of that year, it's like something flipped, and you started seeing kind of that it was the market was so hot, right? And then all of a sudden, I started hearing from some of my, you know, the people that I work with in the venture space start talking about they're pulling term sheets. Term sheets are changing. And I think it was just them anticipating this rise in the discount rate and what that ultimately means to assets that have duration on them. And if you think from a macro perspective, venture has a very long duration. And so when you start to think about interest rates moving up meaningfully and you got a lot of uncertainty around that, it makes sense that term sheets start getting pulled on assets that you may have been on the fence, maybe slightly on the margin positive, and you had hope and you were position sizing it well for a portfolio. And then all of a sudden you're like, this is probably way too high of a valuation. I saw that trend really popular in late 2021 throughout last year.
Right.
So that wouldn't be, you know, and that's what I'm seeing still. But again, I'm not like Nick seeing a lot of the data, right? It's just kind of anecdotal and through my network, really.
But I mean, Clint too. But if rates are going up, like the Fed funds rate's going up, and you don't know where it's going to stop, I think that makes
can't model exits.
It's like you can't
model exits. You
so everything's like on hold until do you agree that once we hit kind of a level where they hold it, then like I think deals will start to happen again because people can put a number to things.
Yeah, absolutely. If you look at it, peak tightening happens, you know, several months in advance of when you start to finally get things normalizing from a rate perspective, and that happens post, you know, because peak tightening happens so close to peak demand destruction, and we frankly, unfortunately, just haven't reached there yet. And that has a lot to do with the sensitivity to policy shifts that now inflation expectations have. And there's a lot of structural, we don't have enough time to go over all the structural imbalances that create that type of situation, starting with labor and going on down the line to even commodity prices, et cetera, or commodity supply and demand issues. But ultimately there's a lot of sensitivity to policy shifts. And so you're going to have a tighter for longer Fed, which is going to create a lot of uncertainty about where that terminal rate is, where peak tightening is, and then ultimately where the worst part of the economic destruction is. Because who knows at this point, could it last for a long time? You hear people talking about rolling recessions or whatever. How long does this liquidity trend last? And I think that's the big trend is we've had this liquidity wave by the Fed, and that stopped all of a sudden and is going the reverse direction. And I think that just creates a ton of uncertainty. So valuation should come in based on that information.
Yeah.
So go ahead.
Actually, when I hit on that, so I think a trend that we're seeing, and it's almost counterintuitive to what Clint was saying, is we're not seeing a lot of early stage investors becoming late stage investors, but we are seeing a lot of late stage investors becoming early stage investors. And I think it's not for the reasons that Clint mentioned, because it's almost like your risk profile is going to get pretty rough. Well, if you go earlier and rates are up and cost of borrowing is through the roof, right, as these early stage, but also you can almost think of it in this market as your all the data that you show that's from ApeView is late stage. But if you can get your head below the parapet and go earlier and earlier, no one's going to know what the hell's going on. And then you've got a lot of time. You just bought yourself 10 years potentially on some of these that you can make and build this company up to be for greatness, right? So I'm just curious about what you guys are thinking on that, because it is almost counterintuitive, but we're seeing money flow earlier from all the conversations we're having, not the other way around.
That makes a lot of sense, Nick, from a check size perspective too. If you're thinking about it from a VC position sizing, risk management, right? You can write a smaller check size, have more influence most likely, right, over the business. And they probably look at that and say, hey, I do have this long-term time horizon. And if I can really get behind this company, I can cut a lot of small checks. It's a lot better than cutting a big check and I'm not the biggest player at the table. And all of a sudden, we're going through down rounds. Right. Late stage becomes super risky. It's just more liquidity dependent, and they're bigger. Okay. So it's actually not as counterintuitive as you think about it. It's a great point.
I got to tell you, so that is what I really wanted to talk about with this particular topic, because what you just said, Clint, I think is driving a lot of the news that we're seeing with like Stripe, right? And like some of these companies have employees that they have like basically like a liquidity issue. The options are vesting. Right. And the employees don't have any recourse. They need options to get liquid. So this is my questions. Like Stripe's out there trying to raise capital right now, $3 billion. I just saw an article this morning. Doesn't sound like it's going so well, right? I mean, that's totally anecdotal, but we'll see. So like if they can't raise the capital to do this for their employees, like I don't know what other recourse they have. They have to go public, whether the market's good or not. Like I don't know if they have a choice. Or the employees eat it and their options just expire and they lose their money.
Or they take on debt and it's called expensive debt. And so I think you're going to see a lot of companies take debt on if they can. And that's going to, think about it.
So that's just kicking the can down the road, right? Is that
exactly
fair?
Extending pretend.
But it's also potentially a death warrant for the common shareholders, right?
Yeah.
Because now you're further down the capital stack, and you're not getting that money back unless there is an IPO, like Aaron's saying. So even with M&A, you keep on layering these preferences over the top of the common shareholders. Eventually, your employees, your commons, are going to get smart.
Yeah.
And there's no exit. You got to go for IPO, in my opinion. Otherwise, your employees are going to revolt.
But some debt would be okay though. I mean, like if Stripe's doing $3 billion and they have a $55-60 billion valuation, like that's not an insurmountable amount of debt, right?
Yeah, but didn't they lose $500 million last year?
They did, but that was their first unprofitable year, I think, in several years. They did $400 million
the year before, right?
Yeah, the year before, and the management's saying they can basically turn the dial and get back to profitability. So, and the other thing they mentioned in this article that I read was that they've raised, I think they've raised $2.6 billion. Don't hold me to this, but they've raised like several $1 billion. And they've only burned through $150 million of that. So they got a big cash pile too. So like I could see them, In Stripe's case, now, like to your point, Nick, I don't know if every company's like this, but Stripe, I think, has a nice balance sheet, and they could probably stomach that based on the size of the valuation to take care of their employees and get them liquid out of this stuff. But every company may not do that. So it just, to me, that dynamic is super interesting when you got these crossover folks that were really kind of driving the secondary market, late stage secondary market, and now they're moving to earlier stages. Or perhaps just moving back to the public markets because there's so many companies that are public and attractive valuations right now, just playing that space instead, that you almost wonder if it's kind of taken an option away from these CEOs or these pre-IPO stocks that they just have to go public. Now they have to IPO or do a direct listing or something, right? That's not, staying private and raising capital from, these crossover folks.
Yeah, I mean, this reminds me of my friend Tom Holliday says, he used to be at Titan Advisors. He's now with Holiday Investment Partners, but he says there's 3 risks you can take. There's concentration, there's liquidity, and there's leverage. And there's 2 of those you shouldn't take at the same time. And that's leverage and liquidity. And I think what you're going to have is you have these companies that have these liquidity issues and liquidity is going the wrong way from a macro perspective. So there's less and less of it and it becomes scarce. That's why you have this preference for profitability. They're going to have a choice to make. Do they lever through taking on debt, right? Or do they do something like this? It's going to come down to a weighted average cost of capital decision. It's going to come down to a lot of things, right? There's stakeholder analysis, but it's going to be a challenge. And I think it's that challenge, to put my investor hat back on, creates a significant opportunity for investors. It really does. If any of these things start to play out to where there's a lot of pressure on these companies, they're going to be willing to take a less and less of a valuation or higher and higher
Clint,
yield.
Do you like the debt or the equity? Like right now, if you had to come into these companies,
because I want to come in on a from an investor perspective, I want to come in on the cap stack ahead of common shareholders. So I would rather be on the debt side, especially at this point right now. Plus, I understand the principle that if this lasts longer than ever, right? And I position size the debt properly, I underwrite it properly. Guess what? They're going to need some more debt. They're going to need more leverage, and I'm just going to get a continued claim on those assets. And if I'm confident on the company and they can service the debt, why wouldn't I do that?
Listen, I got to tell you though, it's like really interesting to me. This venture debt. I guess you can call it venture debt. I don't know. Stripe's a $55 billion valuation company. If they were public, they'd be like top 150, top 200 in the S&P 500. I bet. To a company, every company in the top 200 of the S&P has debt on their balance sheet, right? So it's in. But I would assume, or maybe let me ask a question. I haven't seen a lot of these venture debt deals, to be quite honest. I mean, is there a risk premium because it's a venture-backed company, or are they getting similar terms as these publicly traded companies that are have a $50 billion plus valuation?
I haven't seen any on the late stage side. So there's a wide gap from a risk perspective on the venture debt deals I've seen for earlier stage companies. And I like those, especially like that pre-A round, right? They don't want to have a down round from their friends and family seed to their A round. And so the business is cutting money. They're still lean, right? Everything's kind of working. You can get some pretty good terms in a situation like that to allow them to kick the can. What does that look like? Is that like a 1-year loan, 2-year loan? Like, I mean, they're paying you back probably pretty quick, right? Yeah, it's usually a 1-year loan. Depends on where they're kind of targeting, where they are in their life cycle and where they're kind of targeting their A round. But usually they have the ability to refinance you out, take you out. Usually an equity holder could take you out. It's a very friendly group typically in the cap stack. And they just want to do this so that they don't have to go through a down round because they want to see successive up rounds. So I think it's a very attractive space there. Obviously, you got to do your DD and be selective and pick your spots. But that's where I've seen some good risk premium. And there should be a risk premium, right? I mean, you're going to get on, if you're thinking about over Fed funds, the Fed funds rate, let's say terminal rate's 5.5 on the high side. You should get a nice risk premium. I think 15 to 20% yields on an unlevered basis make a lot of sense here.
That's wild. All right.
It's and just super interesting to Clint's point here. If you actually compare it to PayPal and Block going back public, it's right between the two. It's actually bigger than Block or Square at this point. So I think market cap was like almost 50 billion.
You're talking Stripe. You're talking Stripe, right, Nick?
Stripe is bigger. in terms of the valuations that we're seeing than Square is. And
Oh, interesting.
Yeah, it's also it's curious if you look at how far PayPal and Block came off. I think from the last funding round, it's still performing better than those two, where a lot of private names are underperforming the public market.
Yeah.
Yeah.
I think there's going to be some like really interesting structural stuff that's going to happen in the next like 12 months, right? This concept, I know we kind of talk about it almost every week because I'm a little obsessed with it, right? But this concept of employees, they're terming out on their stock options is like a very real thing. And I either think it's the market's going to find a way to, I mean, the market will find a way to solve for this. Like there's a lot of smart people in this space, right? And they'll solve for it. But I can definitely see like these every 6 months windows like SpaceX is doing. It looks like Stripe's heading that way. And if that's set up and investors know that that's there, I think you'll attract more people into that company, into the space, right?
And it's a strong company. I think it does. You have to have a strong company. And I think Stripe definitely fits that bill, right? As the SpaceX.
Well, but Clint, it's also not like a Roach Motel either. Like if you know every 6 months there's like a hard price that's out there and people are transacting, then you know you can get in, but you can also get out at like a fair price. So like you know what I mean? Like now, like you kind of buy in. You're like, oh, I don't know if I can get out or not. Like at some point in the future, like there probably is no problem getting out, but you know, like that. There's something to that. I think, especially if these companies, like if Stripe doesn't go public now, okay, when are they going to go public?
Yeah.
5 years, 10 years from now? I mean, like, you're not going to make that decision today and then 2 years from now change your mind and decide you're going to go, right? I think you're like locking it in for another 5 years plus. So, you know, if you're an investor and you want to kind of swing in and swing out on a position, if you know that you're going to have a liquidity opportunity every 6 months, I think you probably do that, right? It's a lot more comfortable to do that than their name. But
I can't wait to see the first big company, like top 15 pre-IPO, go public, just to see market's reaction and really get a feel for the demand.
Yes, it's going to be fun.
That's going to be a great one.
Well, Lord knows there's enough companies out there that need to do something, right? I mean, there's been nothing happened in 2022, so there's got to be a ton of pent up demand on that side of the.
They've got to get liquidity to keep the growth engine going.
Yeah,
I'm just still hung up on the Roach Motel analogy. I love it. Unreal. Well, maybe, and then in terms of what's coming public, maybe we have to look back at some of the S1s that were filed 2 years ago that never went anywhere, right? I mean, they're waiting.
Yeah.
So that could be a really cool topic for next week or a future week. Those are the ones that are in the wings and people already had their eyes on them. So
right.
Pretty cool.
Yeah, let's do a review of those. That'd be fun, like the biggest ones, see where they're at.
I'll check them out. See what I can pull together. All right. So anything else on you guys' mind in the world of tech and pre-IPO stocks? Like, what do you think?
I'm just thinking about when I have to use that term Roach Motel with somebody. That's too good. No, that's great.
So full disclosure, I didn't come up with that on my own. That was my boy Brendan Ahern at Crane Shares, the CIO. He loves a good Roach Motel. But I don't know. Like any AI. What's the latest in AI? What's your favorite AI use case this week? Right.
I mean, I was reading that article about the guy invented the internet. And he was talking about pods of data and all that. You know, we talked about eventually everyone owning their own data. And that was kind of I wasn't prepared for this. Otherwise, I'd have had the article to you. But one of the things that I was reading that I thought was just so fascinating is you start to think about how exponential this AI becomes in terms of how it organizes and disseminates information. And just how fast that growth curve is. And it's really unfathomable about how much it'll help. But I mean, you could have companies with one person and a team of AI assistants doing coding for you, doing your content production and editing, and just anything you can learn, doing your law, doing your accounting. I just don't think we quite understand how much this could change. You know, I'm just obsessed with reading smarter people than me in the which is everyone in the technology space, so I can learn as much as possible about like what they're thinking, because it's just incredible. I always say this: I think we're living in the best time to be alive. It's one of the best times to be an investor in the best time since I can remember, in the last 20 years at least. And I think from a exponential growth rate in technology, and you start to think about blockchain and AI and just all these just massive leaps we're taking, I mean, think about what the internet creation did for us as human beings, right? Decentralizing information and sharing and building a community. Now in network effect in full effect, right? Think about now when the leaps we're making in terms of the infrastructure of that through blockchain, or maybe not through blockchain. Maybe everyone chooses centralization. And then AI. And you start to really just get super excited about the time we're living in, man. It's just unbelievable. I mean, I think we're going to solve big problems, and I think society's going to be better off, and I just can't wait to see how it manifests.
I agree for that. I agree with that definitely. And my thesis and the stuff I love to talk about with folks is I just think everybody's lives, like their day-to-day lives, are going to be very different in 10 years' time than they are today. And I think like kids that are born now, will be blown away by how remedial it was that people used an iPhone, right? Like that's crazy. That's like ancient, much less a regular telephone on the wall or a fax machine, right?
So you're going,
like
you're
I had
going
when I grew up.
the Neuralink path, right?
There's so much.
Tap
like,
your watch and you're already talking to mom, right?
There's Neuralink. There's which for those that don't know, that's like a computer chip in the brain, right? There's photorealistic avatars in the metaverse. There's augmented reality with contacts, right? I mean, there's just like there's so much, There's AI, right? And the productivity that we'll get from that. There's like self-driving cars. The list goes on. It's crazy. And this stuff is like happening.
Biomedical. We always forget about nanotechnology and all the things we're going to do from a diagnostic perspective medically. And imagine what AI can do with that data.
Right.
That's why data is the most precious asset at this moment.
True.
A lot of people say it's time, it's data, and I hope we get to a point where each individual owns their data and can sell it, because I think that's the business model of the future. That's what I'm cheering for.
It's very smart. Well, needless to say, it's going to be fun. I mean, those with young kids, I think I don't know how you parent through some of this stuff, but it'd be its own unique challenge.
Chat GPT is going to be the parent. Because my daughter already Googles everything I say. I'm like, I don't care what Google says. Like, it's my rule. Googled instantly through her phone because she just holds up the speaker and whatever I say, it automatically Googles. I'm like, this is terrible. So imagine ChatGPT. She's like, ChatGPT said you were wrong.
Listen, man, you got to hire a developer, have them build a little bot for you, and every time she hits you with that, you hit her back with a ChatGPT. Right?
That's right. That's exactly right.
I love it.
Hey, think about your sales team, right, Nick? You just have a bunch of people in the metaverse, but it's not people. It's just Chat GPT people, photorealistic avatars that are interfacing with people over a Zoom call and answering all their questions instantaneously, knowing everything about your business, about the product. I mean, it's pretty awesome.
Maybe we'll go in that direction. And I will just say I'm thankful to be in the data space. Growing ARR, that's the goal. But if I weren't, I would be learning how to drywall, because there's no way AI is going to take over.
Learn a trade.
You always need your trades.
That's right. Well, no joke. All right, so no joke.
So we got to start a fund buying trades, only trades. Just buying trade companies, small businesses.
I got a guy on the Upper East Side. If we want to do it, he could take care of us. He does it today. But Nick, no joke. I heard Elon Musk talk about that Tesla robot, the I think it's called Optimus, if I remember correctly, building houses.
See, I'm already outdated. So
yeah, so like he was like, I think it was him talking. It was either him or somebody talking about his robot. But they were like, 40 robots. You point over to a point of land and say, "Go build me 10 houses," and you come back in 3 months and they're all built.
Yeah, they never stop working.
It's 24/7. Yeah. So who knows, man? It's the world's changing fast, but I do agree with you, Clint. I think it's changing for the better, right? I think a lot of people are spooked by this, maybe can't really understand it, but I think it's going to be much, much better, for kind of everyone and for society. But step by step, right? Every year is going to get different. All right, cool. All right, thank you, gentlemen. I appreciate your time today.
Love it.
See you guys.
That's
Thank
right.
you.
Oh, yeah,
Bye.
man. Cheers.